Okay, so your business is booming, things are going great, and you're thinking it's time to bring in a new partner to really scale things up. It's a super exciting moment, right? But it's also a huge financial puzzle. How do you welcome someone new into the fold while making absolutely sure that all the value you already built is recognized fairly? It's a question every single growing partnership has to face.
So let's dive into the financial playbook for this. First, we'll look at why this is such a challenge. Then we'll see how accountants get the books right, figure out how to share future profits, put a price on something invisible called goodwill, and finally, see what that brand new financial picture looks like.
All right, so here's the fundamental challenge we're up against. The numbers sitting in your accounting books, well, they're often a snapshot from the past. The value of your building from 5 years ago probably doesn't reflect what it's worth today, and that makes bringing in a new partner really, really tricky. And this right here just brings the problem to life, doesn't it? Look at the balance sheet for our original partners, Ram and Mohan. It says their building is worth $18,000, but in today's market, it's actually worth $25,000. At the same time, some of their machinery has lost value. And maybe most importantly, their amazing brand reputation, that Goodwill, it's not even on the books. It's listed as zero.
This is the million-dollar question for the founders, isn't it? If the new partner, Sham, just comes in and buys a piece of the business based on those old, outdated numbers, he's getting a huge benefit from all that hidden value for free. And that's just not fair to Ram and Mohan, who put in all the blood, sweat, and tears to build it. So how do we fix this?
So how do we solve this puzzle? Well, the first tool accountants pull out of their toolkit is something called the revaluation account. Just think of it like a temporary financial workspace. It's where we update everything before the new partner officially signs on the dotted line.
And its purpose is really simple. It's all about making the books match reality. We go through and record all the increases in value, like that building, and all the decreases, like the old machinery. We even account for any new debts or liabilities we might have found along the way.
So here's how this fairness formula works. On one side of the ledger, you tally up all the good news, the gains, like the building's new value. On the other side, you list the bad news, the losses, like the depreciated equipment. The difference between the two is the key. And here's the most important part. That net profit or loss belongs only to the original partners, Ram and Mohan. It's their financial reward for the growth that happened on their watch.
Okay, let's put some real numbers to this. You can see the building's value went up by $7,000. That's our gain. Now, from that, we have to subtract $3,000 for the machinery losing value, $500 for some potentially unpaid customer bills, and another $1,500 for a liability we didn't have on the books before. You do the math, and what are we left with? A net profit of $2,000.
And that $2,000 profit, that's the payoff. It gets transferred directly into Ram and Mohan's personal capital accounts, giving them credit for the value they created. Now, with the books totally up to date and accurate, the firm is finally ready to welcome its new member.
All right, we've settled the past and made sure it was accounted for fairly. Now, we've got to talk about the future. How is this bigger, better team going to divide up the profits now that there are 3 partners instead of just 2?
This was the old world, nice and simple. Ram and Mohan shared all the profits in a 3-to-2 ratio. Basically, for every 5 rupees of profit the company made, Ram got 3 and Mohan got 2. Easy peasy.
And here's the after picture. The new partner, Sham, comes in for a 1/5 or 20% share. So everyone agrees on a brand new ratio, 5-to-3-to-2. Ram's share is now 50%, Mohan's is 35%, and Sham gets his 20%. The whole pie is hopefully going to get a lot bigger, but everyone's slice looks a little different now.
And you might think, okay, it's just a new ratio. But this is absolutely critical. Making this new agreement official and putting it in writing is essential. It gives everyone total clarity and prevents any arguments down the road about who gets what. It's a cornerstone of the new partnership agreement.
Okay, now we get to one of the most fascinating parts of this whole process, goodwill. I mean, how on earth do you put a price tag on something you can't even touch, like a company's stellar reputation, its loyal customer base, or its powerful brand name?
Goodwill is exactly that. It's the value of your business that goes way beyond the physical stuff like buildings or computers. It's the secret sauce. It's the reason customers choose you over the competition and keep coming back. And for a new partner, buying into a business with strong goodwill is a massive head start.
But here's a twist. What happens when the value of that goodwill isn't actually written down or negotiated up front? Sometimes it's just implied by the deal itself. So, how do accountants become detectives and uncover this hidden value? It's actually a pretty clever bit of logic. You just work backward. If the new partner paid $25,000 for a 1/6 share of the business, that implies the total business must be worth $150,000, right? But then you look at the actual capital on the books, and it only adds up to $105,000. So where's that missing $45,000? That, my friends, is the hidden goodwill.
So, we've revalued the assets, we've set new profit-sharing ratios, and we've accounted for that invisible goodwill. After all that hard work, what does the business actually look like? Let's put all the pieces together and check out the final updated balance sheet.
And here it is, the grand finale. This new balance sheet reflects today's reality, not yesterday's. You can see the building's updated value right there. You see the new cash in the bank from the new partner. And on the other side, you see all three partners' capital accounts. Ram and Mohan's have been boosted by that revaluation profit we calculated. Everything is fresh, accurate, and it balances perfectly.
So why do we go through this whole song and dance? Because it's not just about numbers. It's about setting the business up for success. It ensures total fairness for the founders. It formally recognizes the real value of things like goodwill. It creates a clean, accurate financial slate for the new partnership to build on. And maybe most importantly, it prevents future fights by making everything crystal clear from day one.
You know, when it comes right down to it, it all boils down to this one simple but really powerful idea from our source material. The entire purpose of all these steps is to create an updated, accurate, and fair balance sheet on the exact day the new partnership officially begins. It's about starting the next chapter of your business on the strongest, most honest foundation possible.
Because at the end of the day, bringing on a partner is so much more than just a handshake and a new name on the door. It's a complex financial merger. Following this playbook ensures that all the excitement for the future is backed up by fairness from the past and a solid plan for shared success. So the real question is your business financially ready for that kind of growth?